Yep. So if their income is under $100,000, they can take losses of up to $25,000. And then there was a phase out all the way up to $150,000 in income, and over 150, no passive loss can be taken. So in this case, this taxpayer is under $100,000. So they are able to take advantage of the loss from the rental property. So they're good to go on the federal return, right? That's pretty clear. I think we're all pretty straight on how that works. Let's now look at the tax returns. We've already established that they are a Virginia resident, so we know they have a filing there. They have a business asset in service in North Carolina, so they had to register as a foreign entity. So we know there's going to be some kind of filing potentially required in North Carolina. Now, what are the rules around, like, how do you decide if a return needs to be filed in a state or not? What is one of the criteria? I probably didn't ask that right, so I'm going to give you the answer. Most states have a filing threshold, right? Income below the filing threshold, you don't have to file in that state. Now, in this scenario, North Carolina does have a filing threshold. For a single person in 2023, it was $12,750, so the standard deduction. In this scenario, the rental property resulted in a loss. So they don't have net income, they actually have a net loss. So is negative $3,997 more or less than $12,750? It's less, right? So technically, this person would not have a filing requirement in North Carolina. The return, and let me jump to the second page because their scrolling doesn't work so great. Maybe I'll jump to the second page. My computer doesn't freeze. The return, when we get to that page, it's going to list the adjusted gross income, the federal adjusted gross income at the top of the North Carolina return. It's going to list any other deductions, subtractions. It's going to subtract out North Carolina. Sorry, y'all. I told you my internet was being wonky today. And it kicked me out. Give me just a second to get this back. So anyway, the North Carolina return is going to start by reporting the federal adjusted gross income, subtract any deductions, exemptions, any of that stuff, subtract their standard deduction to arrive at taxable income. And then there's going to be an apportionment factor. What percent of the income is allocated to North Carolina? In this case, it's going to be zero because there is no income. Right? There was a net loss. There is no income to allocate to North Carolina. So the bottom line number is going to be a zero. So here's my question to you. If you have a client with a rental property that is in another state, so a state where they are not a resident, and it shows a net loss, as a lot of rental properties do, right? They can be truly cash flow positive, but show a loss on a tax return. So they're below the filing threshold for that state. Do you file a return in that state anyway or no? This is more of an opinion, right? Because they're not required to file. They're below the filing threshold. So they're not required to file. So my question to you is, knowing that there are business assets in service in that state, do you file a return anyway, or do you not file because they're not required to?
We always file because typically they have state franchise filings that have to happen of some sort, and they're typically looking for an income tax return. We've gotten hit with that on business clients before. I have no filing requirement, but I said that I did business in that state, and then they pro forma filed tax returns to fill it in, and now I owe a ton of taxes for that state when I had no income.
I can see that. Sean, you're not muted. What about you? What is your standard practice?
I do it almost for that same reason, and also some states do allow carry forward.
That is true. The other reason, so I'm in total agreement. We tend to file anyway. The third reason that we tend to file is eventually that rental property is probably going to sell. And so we're going to have some kind of gain that could be over the standard deduction or over the filing threshold in whatever year that is. And if that's the first time North Carolina sees a return with that asset reported, it could raise questions. Now, it's easy for us to prove that there was never a filing requirement, so no harm, no foul, but I would rather just have it out there and have it be tracked so that there are no questions down the road when that asset sells. So here's that second page of that North Carolina return. We have our federal adjusted gross income. We have our standard deduction, our deduction amount. Here's line 13 is that part year resident, non-resident taxable percentage. In this case, it's 0 because none of that federal adjusted gross income is a positive income amount to allocate. Now, if instead their rental property was cash flowing, then this would likely look different. And we can do a sample scenario with that. This percentage would change. That doesn't necessarily mean there's going to be any tax due, right? It could still be lower than the standard deduction. So they may still have no tax liability, but it would just change this percentage. And then on the Virginia return, same thing. We start with our federal adjusted gross income. Here, there's no adjustment. There's no reduction for the net loss, or if there was net income, there would be no adjustment, even though it was earned in North Carolina, because here on line 24, credit for schedule OSC, which is taxes paid to another state, whatever the tax liability was in North Carolina, they're going to get a credit for that here, and it would reduce their tax liability in Virginia. So it is going to affect their Virginia return potentially to a certain extent, but not by a huge amount. Any questions on that so far? I am curious because we have a few more people who've joined on since we started. By show of hands, or you can pop in the chat or you can use the little hand raise button. How many of you have had clients that either own rental properties in states other than where they live, or who have done this weird LLC in a different state and rental properties in other states? So you've had to run into this kind of stuff before. Yeah, it's pretty common. And I feel like it's becoming more common. It's like I said, they're all going to the same courses, or they're all watching the same social media videos or something. So I'm going to go into this return and we're going to change the rental income to a big number so that we can see the impact if there was actually net income on this return. Let me make that. Sorry for all the lags. It's when Andy told me he wanted me actually in my tax software, I was like, oh gosh, here we go. This is going to be a whole entire thing.
I know she also didn't give him any property taxes.
Yeah. Yes, I did not. And there is a couple of questions in the chat around how to allocate land. I thought I saw one about land value. We'll come back to that because that's really important. I see that done wrong all the time. And in fact, one of the clients that the company that I acquired, a return they prepared before I owned it just came under audit, and they were using an 80-20 rule for building land. That rule doesn't exist, y'all. So it's a good time. So we're going to talk through allocating land value because that is really important if you have real estate clients. Okay, so in this new scenario,
I'm sorry, sales
Go ahead.
points. I see that done wrong a lot.
yeah. In this scenario, so the previous version, rental income was $13,557. In this scenario is $43,557. So we have a pretty significant net income on the rental property schedule, $26,000 instead of a loss of whatever it was, $4,000. Ignore the fact that there's no real estate tax or homeowners insurance on this return. I'm just using the numbers Andy gave me. Let's go to the North Carolina return and see what that looks like now. So now the federal adjusted gross income is much higher. The income allocated to North Carolina actually exists. And so the numbers in the return have changed. Now, 25%, almost 26% of the income is allocated to North Carolina. So there is an amount that is taxable income in North Carolina. There is an amount of North Carolina income tax due because it is now over the filing threshold. So they have income tax. So in this scenario, they owe $1,079 to North Carolina. When we come over to the Virginia resident return, everything flows the same, but here we see that credit of $1,079 for the tax they had to pay to North Carolina. So again, that $26,000 in change of rental income that was earned in North Carolina is still taxable in Virginia. So it's going to be in the Virginia taxable income amount, but then they'll get a credit for the tax they paid in North Carolina. Now, I will tell you, Virginia and North Carolina, their income tax rates are not the same. So this is not going to be a dollar for dollar reduction in tax, but that's just how it works. They give a credit for the tax paid to North Carolina, and then they still have a little bit of an overpayment to Virginia in this scenario based on the withholding from the W-2. So that's what you should be looking for if you happen to have states that have reciprocity. You'll want to look at the reciprocity agreements to see whether they allow the income to be excluded from one state or the other, or if they get a credit for the taxes paid to the other. Different states do it differently. We no longer have to worry about the passive income or the passive loss rules on the federal return, because in this case, the rental property is showing net income.